Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week. This is a big week for the Fed, for where we're going economically, for monetary policy, and for mortgage rate land. The Fed kicks off their two-day meeting this Tuesday, which concludes on Wednesday with two big pieces of information. Number one, the Fed will announce their interest rate hike decision. Yes, there will be a hike. And second, they're going to have a press conference giving us a little bit more detail and insight as to what they're looking at and what they're thinking and their overall belief about the health of the economy. This should provide us some perspective on why they decided what they did and where they think we're going to go next as a result of what they know to be true. Just a few short weeks ago, the market was expecting a 50 basis point move, 0.5%. But with some new information that's just come out, they are now pricing in a 75 basis point rate hike, which is 0.75%. There's some even calling that it needs to be 100 basis points, which is 1 full percentage point rate increase. And I think we know why. Remember last week when I said that we're going to be keeping our eye on the rate of inflation, not just the number itself month over month or year over year, but the rate in which it's declining. Well, that didn't turn out too good last week. First, on the month over month reading, the market was expecting negative 0.1 on the inflation, but it actually came in at plus 0.1. And the difference between those two numbers isn't too dramatic, but they are in the wrong direction. Added to that the year over year inflation reading only moved from 8.5 to 8.3. Now remember, it was at 9.1, then 8.5, which is a pretty substantial move, but going from 8.5 to 8.3 is definitely indication of a much slower rate of decrease. And the proponents expecting it to have been a good reading were citing that the reduced cost of fuel during the summer months was going to be the catalyst to drive inflation down. But that didn't happen. Even though the fuel cost was a dramatically reduced rate month over month, it still was not enough to curb the month over month into negative territory. It was still higher than expected. So despite a little mini reprieve in our price at the pump over the last month and a half, 2 months, it still was not enough to quell inflation. And I think that is what has them really concerned. Even since the end of August, you might have noticed that fuel prices are already starting to go back up again. So that was just a little blip on the radar. And this week's Fed meeting is really going to be important, not just for the rest of the year anymore. We're talking about important for 2023 and now 2024. And you might have seen last week that there was a lot of discussion around FedEx at the end of the week. Let's talk about that and how that affects the overall economy, which is going to dump into mortgage rates. First things first, FedEx missed their first quarter earnings estimate by quite a substantial margin. Even worse, they withdrew their entire yearly forecast. They withdrew their entire yearly forecast, which just 60 days ago, they were practically bragging about. So it's a stark contrast, not just from what we'd expect from FedEx as a global shipping company, but to have a corner turn so hard from 60 days ago, saying that it's going to be a fantastic year with phenomenal results, earnings are going to be through the roof and everything's looking great, to now just 2 months later going, quarter one wasn't good, and also we're going to cancel our forward guidance for the rest of the year. That is not a good sign. Couple takeaways. First, FedEx is connected to so many facets of industry, so many facets of the global market, and they are in line with the domino effects of whatever happens with consumer goods demands, costs of fuel, costs of labor, what shipping is coming from overseas, even shipping domestically here in the United States. Products and goods that are being bought business to business or business to consumer flow through entities just like FedEx. So in many ways, FedEx, UPS, DHL, and even the United States Postal Service are kind of proxies for the overall health of our economy, the velocity of money, how much money is being spent, where it's being spent, and what the impact of those things is across industry. And that includes labor, that includes fuel costs, that includes costs of goods, that includes costs of raw materials, that includes the cost of fuel, that includes everything that has to do with business. So, citing numerous challenges, their CEO forewarned that there's a little bit of trouble ahead. And there are a lot of connected pieces that have nothing directly to do with the United States, but indirectly are going to have a lot to do with what happens here. That includes inflation. That includes cost of goods and services. That includes overall general health of the economy. And all of these factors together, mixed into the pot, of course, change the spectrum of what we should expect when it comes to mortgage rates. So we got a double dunk last week. When it comes to mortgage rates, on Tuesday when the CPI number came out, the market took an absolute dump. Mortgage rates got worse immediately. And then that was furthered on Thursday after the closing bell when FedEx had their announcement. And then Friday when the market opened up, mortgage rates got worse again. So we got double dunked on last week, and we're already starting this week in greater interest rate territory than we were at the beginning of last week. And we have upcoming this week the Fed's announcement, which is going to most likely confirm the consensus that's happening on Wall Street, and then set a pace for us to expect continued price hikes ahead, and that means higher mortgage rates ahead. Already we're at a place where rates are twice as expensive as they were at the beginning of the year. Remember in January, rates were in the 3s still? Well, now we're talking about rates in the high 5s and the low 6s for 30-year fixeds. So without any of the fundamental underpinnings that are causing all this changing for the better, it's really unrealistic for us to expect that rates are going to get better until those things also change. What we're seeing right now is a broad adoption of higher rates across the board. They're high everywhere relative to where they were just a few months ago. Until we start seeing things change in the fundamental side of the economy, of business and industry, and specifically the mortgage-backed securities market, bond and interest rate market on Wall Street, this is unlikely to change. Heading into Wednesday's Fed rate announcement, here's two things I want you to be looking for. If there is only a 50 basis point change, which is unlikely, you might see rates dip really quickly, maybe for the day and a half or two, and then come back to where they already are. If the Fed comes out with a 100 basis point rate hike, then I expect rates to go up immediately and stay there for the remainder of this week and into the end of September. Now, if they play it right down the middle where we think they are at 75 basis points, expect very little change with rates this week. I think what will happen is that being confirmed and locked in for at least the next 6, 8 to 12 weeks, that's going to set some precedents for us to kind of float around where we're at right now, plus or minus about an 1/8 or 1/4%. That means on any given day, the rate might go up or down an 1/8 or up or down 1/4, but probably not much outside of that boundary. If we get on the low side, 50 basis point hike, we'll probably see a little bit of a dump. And if we see the 100% basis point hike, you're gonna see rates just go up, and they're likely gonna set a new margin higher than where we're at today. So in conclusion, what we're looking at moving forward is all transactions are very much going to be personal and circumstantial based. You're probably thinking, well, yeah, aren't they always? Well, yeah, they are, but that can be heavily weighed in on when the market is in your favor in all facets and aspects. But right now, with less of those things working for you and the cost of money becoming more, you still have things in your favor, but the circumstances that you need to execute on are going to be the difference maker on whether you do something or do not. For example, if you right now are still looking to build an ADU and you have massive equity in your house, that circumstance may cause you to still look for the cash out refinance or the home equity line of credit. If your job situation is such that you're moving out of San Diego to take a new career path, then you might need to sell your house now. If you're PCSing to San Diego in the next 6 or 12 months, you're already looking for a house here in San Diego and you're preparing your finances for a purchase here in town. So those are just a couple examples where maybe the rate doesn't matter and it's not the end all be all for your circumstance, but your circumstance is still happening in your life and you need to make a next right step in real estate and mortgage. So if you're watching this video and you missed our conversation about the home equity line of credit, you can watch that video by clicking up here. If you're watching this video and you have extra space on your lot of land and you've been considering converting a part of your home into an ADU or adding onto your home to convert and build an ADU, you can watch this video here. Everyone else watching that needs to do cash out, access a line of credit, cure some debt, maybe you're thinking about moving up, moving lateral, or even downsizing, please go ahead and like this video, send us a comment, shoot us a DM, you can even call or email us. Let us know what it is you're trying to achieve in real estate right now, what circumstances are causing you to make some of those considerations, and we can match and pair that with what's happening in the economy right now, what's happening in rate land, what kind of products and services are available in the mortgage side of the business to best help you achieve the outcome you're hoping to get. And as always, please share this video with people you know, like, and trust, people that you know need to get some front of the line information of what's happening, how it's impacting the market, and what that means to them on their specific set of circumstances. Share this video with them and help them out. Thank you so much for watching this week's video, and we'll see you again next week.